Hi, welcome to the second edition of my Navigating the Noise YouTube series, this one about the Fed, and the tagline being, Policy Misstep Now, Recession Later. The Fed raised rates 25 basis points at last week's FOMC meeting, but that wasn't a surprise. The surprise was the hawkish tone and the aggressive dot plots. The median projection for the funds rate for the end of this year was hiked 100 basis points to just under 2%, not to mention the added threat of quantitative tightening coming our way as early as the next meeting in May. So call it a double whammy. The Fed has never before tightened in such a maelstrom. A shooting war, a pandemic, a weak and wobbly stock market, and an incredibly flat yield curve. The only way to combat such cost-push supply-side inflation is to crush demand. It's as simple as that. Recession odds just took a leap forward, but I don't think the Fed is going to discuss that openly. They never do. Just know that Fed tightening cycles stand a 75% chance historically of triggering an outright recession. It's only the timing that's up for debate, and that this moves to 100% odds once the 2s10s Treasury curve inverts, and right now we're less than 20 basis points away from that happening. Now the Fed is putting on a very happy face when it comes to the economy, but the Fed will never come out and tell us how it really views the macro outlook, because it always and everywhere is the nation's economic cheerleader, keeping in mind that despite 400 PhD economists on staff, the Fed in the past has only gotten its GDP forecasts right 17% of the time. And two-thirds of the time in the past when it wasn't right, it's because it was way too positive. But that is the nature of the institution. What's truly incredible is how often the Fed gets the one thing it actually directly controls with accuracy, which is the Fed funds rate. Just a 37% accuracy rate. And yet again, when it's missed the Fed funds rate projections in the past, 93% of the time, the Fed was too hawkish. To which I say, welcome to deja vu. But the cat really came out of the bag in early March, when at his semi-annual congressional testimony, Jay Powell really played tough guy and came right out and told Senator Shelby in a question about Paul Volcker. And he said in quotes, "I think he was the greatest economic public servant of the era." End quote. Big statement. Now let's see. How did this greatest of them all kill inflation? Answer, through back-to-back recessions in the early 1980s. That's how. And that's the only way to crush inflation caused by global supply shocks. So the central bank has to kill demand. That's the only influence any central bank can have. So Volcker is revered and he's lionized today, but remember that memories are short, because he was reviled in the early 1980s. But the recessions of January to July of 1980 and July of 1981 to November 1982 actually ended up doing the job. It did kill inflation. So Jay Powell seems to fancy himself the modern day Paul Volcker. This means he's going to be willing to invert the yield curve and crush demand. And I think that he's going to be successful. And remember that Paul Volcker is credited for ushering in that secular 2-decade-long bull market in equities that started in August 1982. But also remember that that bull market was built on a price-earnings multiple that had gotten down to 8, not 19, as is the case today. A double-dip recession that did kill inflation also killed all the speculative excesses of the day in risk assets and culminated in a 30% bear market in the S&P 500 over a 2-year period. That's the past, but it's also our future. This bear market has already started, so be wary about buying any dips, because there is no near-term catalyst, and the Fed is not going to be holding anyone's hands until it sees the whites of the eyes of the recession, and by then it's going to be too late. So my advice is hunker down, continue to get defensive in your portfolio. That means consumer staples, it means healthcare, and it means utilities. And yes, cash. And I have to say that now that the long bond yield is at 2.5% and priced for a lot of the Fed tightening that I've been talking about, that long-dated treasuries are looking pretty attractive at the current moment as well. Thank you for all the support this series has received since our first video. If you're enjoying the series so far, then please like the video and make sure to subscribe. As well, if you're interested in trialing all the material we are publishing at Rosenberg Research for a free 30-day period, there is a link in the description box below. Thanks again, and many happy returns.